Okay, so now we're into a very important portion of this class, and this is really as it relates to all managing risk and always looking at your risk before your reward. So, in a strategy like this, where you're selling out of the money premium, it is especially important that you are paying attention to the risk that you're putting on, because if you're not paying attention to what you're doing and the market gaps through your strikes, you're going to have a big problem on your hands. So even though this is slow and steady income, the thing is it's slow and steady income, but you still need to put alerts and you still need to pay attention to what's going on, because if the market does go crazy, then you're going to need to manage your positions. So let's talk about how to manage your risk so that you can get your rewards. So first of all, don't get frazzled or dazzled by stats. Yes, the strategy is high probability. When I used to do this all the time, it was literally like 90 to 95% wins. But the problem is you cannot have that 5% of losses that wipes out your whole account. So you have to be aware of this and you have to know how to mitigate it. Typically, what I do is I look at percentage of risk per trade per account and consider hedges, but hedges aren't generally cost effective to leave on all the time. So this is why this type of management is really important. So what are your typical risk parameters? Well, on average, directional options trades, I typically risk between 50 to 60% of my account in a strong uptrending market environment. However, this is not the case with this strategy, okay? That is the case for when there's a daily squeeze on the S&P and I'm trading butterflies and long calls. That is absolutely not for this premium selling strategy. So due to the risk reward, it's critical to take a lower percentage of your account, usually about 20% of your total account. You always have to think of it like this. And I kind of got that way today, because today it was one of my best days on the year this year. And I looked at it and it's like, okay, well, yes, everything's awesome. And yes, I'm making money because I'm risking more money. But you have to look at that and say, okay, if I have 80% of my account in the market and then something terrible happens overnight, do I want that 80% to go to zero? Well, no. So it's the same thing with this. If you have 20% of your account in it, and let's say there's some random flash crash like Brexit, for example, it does happen, not very often, but it'll happen like once every 3 years or so. You need to be prepared for that, and you cannot have all of your money in the market. So the main thing that I would caution you is, as you're doing it and it's working, usually what happens is you get excited, but you cannot do that, because you have to remember your initial risk parameters and you have to keep that in check. So how many of the 7 stocks? Let's talk about this. Normally on a Monday, I'll go through my list, figure out the ones I want to trade. I'll look at where they're at in the market. And see what is, for example, like you don't want to, if you're selling put credit spreads on something that's trading higher and it's at a brand new lifetime high, you don't want to come in and sell a put credit spread on it when it's right near a brand new high. So for example, if there's a ticker that week that's doing that, maybe you'll say, I'm just going to actually wait till the next Tuesday and then I'll do it at that point. So, that's something to keep in mind. The other thing that you can keep in mind is that the more contracts per stock and a smaller amount of stocks, for example, you could do 4 trades with 8 contracts each, or you could do less contracts per stock and a larger variety of trades. So then that way, if there's some type of, crazy price movement, like, for example, the Johnson & Johnson baby powder scandal, then you're not as impacted. Maybe you have one trade that is a loss and the rest of them are fine. So it just depends what you want to do. I kind of prefer this model, and so does Henry. John prefers to do more trades with, or less trades with more risk on each one. So it just depends what you want. Now let's talk about exiting your trades. You can also avoid risk by exiting your trades before they expire. don't be greedy. You don't need to wait until that should be 5 cents, not 50 cents. The last 5 cents of the premium comes out of your options. Next piece, be a bricklayer. Take 30 to 50% profit on a regular basis. It adds up. If you're being greedy, inevitably you will lose, and you will lose big. What's the next piece of this? What is my preference? Well, because of the reality that each trade brings about risk, I prefer to spread my risk with more tickers and less risk per ticker. However, everyone is different. Some may prefer less trades to manage. So, one thing that you can do, have more contracts per stock in a smaller amount of stocks, or less contracts per stock in a larger variety of trades. So we already talked about this a little bit in the last slide, but I just want to hone in on it again because it really is up to you how you want to manage it and what you think the best way is. But at the end of the day, you still shouldn't be going over about 20% of your portfolio allocation on strategies like this. You always have to remember anything can happen. Strategy is great when you're new, or if you don't have a ton of time, or if you like passive income, but beware, because when your wins add up, you may feel invincible. You do not forget that anything can happen, which is why we control our risk. So, I'm sure you're aware, but trading options is inherently risky. And by quantifying first the risk in the environment and then the individual stock, we determine what type of positions and how much overall risk we're comfortable holding. The biggest risk here is a flash crash. That's why no matter how high probability, you must maintain your risk. Another way that I do like to look at risk is based on the dollar amounts of risk per ticker. I also like to look at the type of positions and the overall risk on a portfolio. These variables will change based on the overall market condition. For example, right now, we've been in a bull market since 2009. We have been focusing on upward trending markets, which is a directional market. But if we enter a bear market, or if the market turns into a major chop mode, we need to adjust that. When the market is continuing to go straight up like it was today, July 24th, 2019, then I will put more risk on in those moments because we have a strong market. When it starts getting more volatile, then I will lower my position side. So, really just the idea here is that markets ebb and flow. They don't go straight up or straight down. We can quantify these ebbs and flows, and we can put option strategies in place that can take advantage of it. So as it's ebbing, as it's flowing, we're selling. Ebbing, flowing, selling. We do that through fib, we do that through moving averages, but most of all, you have to just maintain your risk. I showed you my strategy selection risk gauge, so I think it's important for you to fill out one on your own. Think about your own personality, your own trading plan, your own acceptable risk tolerance, and your own time frame. Do you want to be complicated? Do you want to be simplistic? And how available are you to watch trades? These are all things that you need to consider when you're putting together your trading plan. You also need to consider these factors. Like I said, the 20% on your portfolio, but you also need to think about what you are comfortable risking, the dollar amount per ticker, the types of positions you're willing to have on, and the overall risk on your portfolio. Because maybe, for example, you have 20% of the 7 stocks where these are premium selling strategies, and then maybe you have another 20% of your portfolio that is directional trades. And then maybe you have, for example, 10% of hedges or something like that. So you need to figure out between the different strategies you do, because more than likely, this isn't going to be the only strategy you do. You're more than likely going to have multiple strategies on at the same time, and you need to look at your overall risk and the type of positions, not just the risk on these one trades. All right, so setting a stop loss is also very important. This is very critical because one max loss can wipe out many gains. You have to be able to minimize your losses. So typically setting a stop loss between 30 and 50% of the width of the credit of the spread is the best idea, but you have to figure out what works best for you. So for example, if the width of your spread is $2.50, okay, then setting a stop at a 50% stop loss would be $1.25. Even better, if you use a 30% stop loss, your stop loss is going to be about 75 cents. So you can adjust that for a $5 wide or a $10 wide spread. For me, I prefer the tighter spreads, but I mean, really, it's up to you. I typically use a $2.50 spreads just because they have less risk, especially at those strikes when you're doing like one standard deviation. It's not really going to help you that much to do it $10 wide just because the premiums are already kind of low. So you might as well do it tighter and have less risk than do it wider and have more risk. So that's generally the way that I think about it. The other thing that I like to look at is using alerts. So I find the alert feature really helpful, and it can be difficult to know where to put your alert at, but I think one helpful thing to think about is if you go back to that slide where it says where your break even is, any trade you put on, it's going to show you where your break even is. So you see right here in my platform, and everybody's platform is different, but you see how it says break even 121.08 or 128.92. So it's a really great idea to, when you put on a trade, to write down that break even price. And then what you can do is you can go right over to your platform. You can go right over to your platform just like this. And you can right click on wherever that break even price is. So for example, on that trade was PayPal and it said 121, right? So you can come over to PayPal and you can say, okay, well, where was the break even price on PayPal? It was 121. And so you can right click here and you want to create an alert. And then you put at or below, and then you type, PayPal break even. Okay. So that's a great way to kind of manage your risk. That's a great way to kind of manage your risk. And that way, if something's not going your way, you're aware of that and you can fix it. So what about 5-star now? 5-star is a little bit different. The way that you add the adjustments with 5-star, you're going to be doing a 1-to-1 risk reward spread at the money. I still like to keep the 50% stop loss rule. And the thing about this one is if you have a $2.50 wide spread and you have a $1.25 stop loss, if you were already taking a $1.25 credit because it's 1-to-1, you're only losing exactly what you got into with the trade. So for that reason, sometimes I will allow it to go a little bit more, especially because 5-star setups, I'll do them 15 to 17 days till expiration. So especially, for example, like if something in the first 3 or 4 days, let's say in the first 3 or 4 days I got in and it just blew down. Well, there's nothing wrong with waiting another 12 days to see if it's going to come back. Now, with the 7 stocks of success strategy, because you're selling premium 1 standard deviation away, you really don't want to let that go more than 50% because it's going to be really hard to come back and not, have significant losses. So for that reason, you got to be careful about that. Now, I mentioned on the last slide that, what if you think something's going to come back? Well, there's a couple different methods. One of them is just a simple trend continuation and it pulled back a normal area, like using Fibonacci symmetry. But something like this, for example, with Netflix, where it gapped down and it just rolled over and died, you're kind of waiting for, where's the end of this? Well, what you want to look for is you want to look for price to level out so you can see it was falling 1, 2, 3, 4 days. It finally made a low. You get a break of the high of a low bar right here where you finally have a candle trading higher, but you also have a ready aim fire buy, and the VZO is starting to hook around, which is showing volume coming back into the stock. So for me, this, especially the ready aim fire, is showing you oversold, and you're starting to see some life back in that candle. So that is what I want to look for when I'm trying to get in on a low like that. Now, what about gaps? In this strategy, gaps are your absolute worst enemy. The problem with gaps is that you have no idea when they're coming. but the best defense against gaps is a position size to begin with. So really, you have to be very cautious about your position size. And when gaps happen, I mean, it's been pretty rare. The ones that I remember, the 3 that I was in that really got me were this Johnson & Johnson one, which is why I use it as an example, because I remember it very clearly because the setup was perfect. Like, setup was beautiful. It looked great. There's nothing wrong with it. But, you know, it came out that they had asbestos in their baby powder, and people could prove it. So that was a pretty big scandal. Not really helpful as far as the overall stock price is concerned. With something like that, you're not going to be able to do anything about it. You can look at it like I showed you with Netflix to see if it's oversold, see when it's finally starting to come back. But oftentimes it's going to take a while, and it's better to just take the loss so that you don't have to take an assignment. So therefore, you know, therefore, risk above all else. Avoid the enemy, position size correctly, don't over leverage yourself, and especially with out of the money spreads.